Hello and welcome to 5-Year Club video number 279, S&P 500 Futures Edition, and also awkward haircut. That's right, I got one today. My head is a little bit less fluff than it was before, but since the barber next to me was correcting my barber, I'm a little bit skeptical of the results. So I'll just shove the whole thing in a hoodie. All right, let's talk about futures. Not that I know a whole lot about it, but we're going to learn together. How do S&P 500 futures work? S&P 500 futures contracts give buyers the right to a basket of the stocks in the S&P 500 on expiration date. Priced at 250 times the index, they're used mostly by institutional investors. Wow, that sounds expensive. A lot of stock trading is based on what is deemed fair value for the S&P 500 futures. Trading in the S&P 500 futures goes on in Chicago for a half-past hour. In Chicago for a half hour past the New York close. Even after the Chicago close, the futures continue to trade, albeit thinly, in after-hours CME Globex trading. If, in the morning, the futures are trading much higher than the cash S&P 500, institutions will sell the futures and buy the underlying stocks, giving the stocks a boost at the open. If, on the other hand, the futures aren't trading much higher than the S&P 500's close, stocks can go down. So, there you have it. And so you wonder, can you use the value of futures to predict the direction of the stock market? And so this is going to be an article discussing that. Using index futures to predict the future. Updated March 9th, 2018 by Neil O'Hara on Investopedia. An index futures contract binds the parties to an agreed value for the underlying index at a specific future date. For example, the March futures contract for the current year on the Standard & Poor's 500 index reflects the expected value of that index at the close of business on the third Friday in March. Like any derivative, it's a zero-sum game. One party is long and the other short, and the loser must pay the winner the difference between the agreed index futures price and the index close value at expiration. Fair value of an index future. Although index futures are closely correlated to the underlying index, they are not identical. An investor in index futures does not receive, if long, or owe, if short, dividends on the stocks in the index, unlike an investor who buys or sells short the component stocks or an exchange-traded fund that tracks the index. Index futures trade on margin, too. An investor who buys $100,000 worth of futures must put up around 5% of the principal amount, $5,000 at the outset, whereas an investor in the stock components or an ETF must put up the full $100,000. The index futures price must equal the underlying index value only at expiration. At any other time, the futures contract has a fair value relative to the index, which reflects the expected dividends foregone, a deduction from the index value, and the financing cost for the difference between the initial margin and the principal amount of the contract. In addition, between the trade date and expiration, when interest rates are low, the dividend adjustment outweighs the financing cost, so fair value for index futures is typically lower than the index value. All right, so let's back up a little bit because I think that was a bit technical. So when you're holding a future, you don't receive dividends, and so therefore you wouldn't expect to pay as much for it. And so that's the first thing they mean, is that the fair value is decreased by the fact that if you are holding futures that are long on an index, you don't receive dividends, so you don't feel like you should be paying as much for those futures as if you were holding the actual ETF, the actual stock itself. On the other hand, right, let's see, there's a financing cost. So if you're buying these on margin, they want to charge you some interest for the risk that they're taking on for, giving you that credit, giving you that margin. And so this financing cost makes the future more expensive. However, if interest rates are low, then the financing cost is low because, you could get the credit elsewhere, I guess, in theory. Because interest rates are low, so credit's more available. And so what they're saying is, look, when interest rates are low, it's probably the lack of dividend that's going to dominate this calculation and not the financing cost. Index futures arbitrage. Just because index futures have a fair value doesn't mean they trade at that price. Market participants use index futures for many different purposes, including hedging, adjusting asset allocation through index futures overlay programs, or transition management, or outright speculation on market direction. Index futures are more liquid than the market in the index's individual components, so investors in a hurry to alter their equity exposure trade index futures, even if the price isn't equal to fair value. Whenever the index futures price moves away from fair value, it creates a trading opportunity called index arbitrage. The major banks and security houses maintain computer models that track the ex-dividend calendar for the index components and factor in the firm's borrowing costs to compute fair value for the index in real time. As soon as the index futures price premium or discount to fair value covers their transaction costs, clearing, settlement, commissions, and expected market impact, plus a small profit margin, the computer jumps in, either selling index futures and buying the underlying stocks if the futures trade at a premium, or the reverse if futures trade at a discount. So in other words, in the futures market in 2018, we have computers that are automatically bringing these two together. At least it's bringing the fair value of the index future and matching it up with where the stock is currently trading. And that's going to happen extremely quickly, as fast as the computer can probably do it. It's not really a human thing anymore. Especially because the computers that are doing this, I'm sure, live at the brokerage house and they got to pay millions of dollars to have them there. So as an individual, you're not going to be making money from index arbitrage. Index futures trading hours. Index arbitrage keeps the index futures price close to fair value, but only when both index futures and the underlying stocks are trading at the same time. While the U.S. stock market opens at 9:30 a.m. Eastern and closes at 4 p.m. Eastern, index futures trade 24/7 on platforms like Globex, an electronic trading system run by CME Group. Liquidity in index futures drops outside stock exchange trading hours because the index arbitrage players can no longer ply their trade. So in other words, the computers that do this automatically have to shut off because they don't have the real market value to use to, automatically compute the transaction. If the futures price gets out of whack, they cannot hedge an index futures purchase or sale through an offsetting sale or purchase of the underlying stocks, but other market participants are still active. Index futures predict the opening direction. Suppose good news comes out abroad overnight. A central bank lowers interest rates, or a country reports stronger than expected growth in GDP. The local equity markets will probably rise, and investors may anticipate a stronger U.S. market too. If they buy index futures, the price will go up. And with index arbitrageurs on the sidelines until the U.S. stock market opens, nobody will counteract the buying pressure, even if the futures price exceeds fair value. As soon as New York opens, though, the index arbitrageurs will execute whatever trades are needed to bring the index futures back in line. In this example, by buying the component stocks and selling the index futures. Investors cannot just check whether the futures price is above or below its closing value on the previous day, though. The dividend adjustments to index futures fair value change overnight. They are constant during each day. And the indicated market direction depends on the Price of the index futures relative to fair value regardless of the preceding close. Ex-dividend dates are not evenly spread over the calendar either. They tend to cluster around certain dates. So I think ex-dividends, this is like the cutoff date for when you're going to get a dividend if you own a certain stock. On a day when several big index constituents go ex-dividend, index futures may trade above the prior close, but still imply a lower opening. So in other words, let's see, on a day when several big index constituents go ex-dividend, index futures may trade above the prior close. Yeah, because I guess it's because if they've gone ex-dividend and you're buying it, you now have to wait the longest amount of time to get your dividend. And therefore the futures are like, well, buying the stock isn't great because you have to wait a long time for the dividend, but buying the future, you're not going to get the dividend anyway. So they're kind of both bad. So the future in that case might look better for some reason because you can buy it on margin. I don't know. And then so its price tends to stay higher. I think that's the logic. All right. In the short term, index futures prices are often an excellent indicator of opening market direction, but the signal works for only a brief period. Trading is typically volatile at the opening, which accounts for a disproportionate amount of total trading volume. If an institutional investor weighs in with a large buy or sell program in multiple stocks, the market impact can overwhelm whatever price movement the index futures indicate. Institutional traders do watch future prices, of course, but the bigger the orders they have to execute, the less important the index futures direction signal becomes. Late openings can also disrupt index arbitrage activity. Although the stock market opens at 9:30 a.m., not every stock starts to trade at once. The opening price is set through an auction procedure, and if the bids and offers do not overlap, the stock remains closed until matching orders come in. Index arbitrage players won't step in until they can execute both sides of their trade, which means the largest and preferably all stocks in an index must have opened. The longer index arbitrageurs stay on the sidelines, the greater the chances that other market activity will negate the index futures direction signal. The bottom line, if the futures price suggests the market will rise on the opening, investors who wish to sell that day may want to wait until after the market opens before entering their order, or set a higher price limit. Buyers may want to hold off when index futures predict a lower opening too. Nothing is guaranteed, however. Index futures do not predict the opening market direction most of the time, but even the best soothsayers are not. It says index futures do predict the opening market direction most of the time, but even the best soothsayers are not always right. Investors can monitor futures prices and fair values on websites like CNBC or CNN Money, both of which also show pre-market indications for individual stocks, a less reliable indicator due to poor liquidity. I got to ask in an article like this, it says at the end, investors can monitor things on CNBC or CNN Money. Well, do a test, right? Shouldn't you do a test where you just say, well, if I, traded on the stock market every morning based on what CNN says about futures or CNBC says about futures, how would I do? It's an objective thing. It's something we can measure, You don't have to, kind of think maybe this could work after reading an Investopedia article. I don't know the answer to that. That's kind of what I was looking for in the article. My guess is you're not going to make a whole lot of money doing it, both for the reasons listed in the article and because, hey, Goldman Sachs isn't stupid, right? If CNN or CNBC had some magic money-making data, they would just have a computer watch it for them and do, natural language processing or whatever they needed to do to identify the futures price, and see what direction the market was going to move. And then I'm sure they can come up with some new play to buy either short or long or whatever it is on the right side of that equation. All right. Well, that is it for 5-Year Club video number 279. Hope you enjoyed it. Hope this kind of clues you in a little bit on what S&P 500 futures are. Certainly did for me. Good night.